Hey traders, this is MsPutOptions, and today is 7/22/2014. And today we're going to be talking about several things, one of them being the Iron Condor, aka double decker trade, or aka Straddle. But if you have any questions with your broker concerning this particular trade, you will call your broker and ask them about the Straddle. And you spell Straddle Straddle. So we talked about how to actually go about constructing the straddle trade. We know we have to click on custom, and we know we sell one of the options, which is going to be a call option. And the two options in the middle that we buy, one is going to be a call option, the other one is going to be a put option, and they're going to have the same strike prices. And then the one on the bottom, we're going to sell that one. That one's going to be a put option, and that one's going to be for $5 less than the put that we bought. So let's do a zoom here, and we're looking at the ticker symbol is CMG, which is a Chipotle Mexican Grill. And as you can see, we would have got a debit of $4.60. So when we attempt to sell this back, we want to sell it back for $5 because and where we get this $5 is the difference between our strike prices is $5. So when we sell this $4.60 debit back for $5, that will be a credit of 40 cents. And the 40 cents times, let's do the math here, we get 40 cents times 10 contracts times 100 shares, and that's going to give us $400. And so where we get the 10 contracts is right here where our quantity is, and we know this is a monthly option, so monthly options are worth 100 shares. So once again, how we derive at the math is this is initially a debit of $4.60. We're going to sell it back for $5. That would be a 40-cent difference. So we take that 40 cents times the 10 contracts, and we know this is a monthly option, and that's going to be a credit in our pocket of $400 in a total of 3 days, because when we place this option, we want to make sure this is a weekly option so we can get in and out of the trade, and so that the stock can drastically move up or down, because Chipotle Mexican Grill has announced earnings on today, which is 7/22/2014. And so we know when that happens, the stock has a tendency to go really, really high or really, really low. So let's just do a zoom here with these figures. We're going to zoom here. And as you can see, the two strike prices in the middle are the same, one being a call, the other one being a put. And then the one that we buy here on top is a call option. And it's going to be $5 more. You can make it $10 if you want to, but when you make it $10, then you're going to have to change it to buying it back for $10 instead of $5. And that would be going down here. We would have to buy this option back for $10 and not $5. But when we manipulate this number here to have a difference of 10, then our debit is going to be greater. So we're not going to get that far ahead. So let's look here. So we sell here this particular put, the 650 put, which is $5 less. And this is how we derive at our selling back number, because the difference between 660 and 655 is $5, and the difference between 655 and 650 is $5. So we know we have to buy it back for $5, or shall I say sell it back for $5. Excuse me, we have to sell it back for $5 because we're buying this whole option. And when you buy straddle, that means it's going to be a debit, and selling it back, this is where our credit comes in. So once again, we're buying it, so this makes it a debit of $4.60. And so we want to sell it back for $5, which is the difference in our strike prices, and that would be a 40-cent difference, and 40 cents times 10 contracts times 100 shares would give us $400 in a week's time. less than a week really, because today is already Tuesday. So we would have to get in and out of this trade by Friday. So I'm going to pause this video right now, and we're going to go to my actual account in the Thinkorswim platform, and I'm going to show you what I did. Now we are in my actual live account here on the Thinkorswim platform, and I'm going to tell you why I did not place a straddle on Chipotle Mexican Grill, even though I strongly believe that the trade, if you were to place a straddle on Chipotle Mexican Grill, that it would turn out fine. But the reason why I did not place the straddle, if we look at here, this number here, this bright orange number is saying that the market maker's momentum number is $7.88. So what is that telling us? That's telling us that the market makers believe that at any given time, uh, they believe that this number, which is the current price of Chipotle Mexican Grill, can go up or down by $7.88. Now, the reason why I didn't place the trade, let's really think about this. If they're saying that the stock can only go up or down by $7.88, and we have to sell it back for $5 when we do the straddle, then that means that the stock has a narrow chance of going up or down. I like this number to be at least 20 or 30 when I'm placing my straddle. So this is telling me they believe that Chipotle Mexican Grill can only go up by roughly about $7.88 at any given time. So when we're placing the straddle, and we're going to go away from this page for a little bit, and I'm going to put this on hold again. All right, so we are looking at this diagram that I made here, and the reason why I did not place a straddle on this particular Chipotle Mexican Grill is because currently Chipotle is only trading for, I believe it was $659.77. So when you're placing the straddle or iron condor, you need the stock to be outside of your 660 strike price. So it has to be above 660 upon expiration, or it has to be below 650 upon expiration. You do not want it to land here in the middle of your strike prices, or this will cause you to have a partial credit or a total loss. So if Thinkorswim is telling me that Chipotle Mexican Grill is only going to move roughly about $7.88, and is currently trading for 659.77, that's not giving this stock a whole lot of room to move above my 660 strike price or below my 650 strike price. So when I'm looking at that momentum number, which is very, very low, the possibility of a Chipotle Mexican Grill falling in between my strike prices is great, because the market maker's momentum number is saying $7.88. So this is my reasoning behind not placing the straddle on Chipotle Mexican Grill, because once again the momentum number says that they believe this stock can only move up or down by $7.88. And so this would put my strike prices at jeopardy, and I would be either at a total loss or a partial profit, and that's not the goal. The goal is for me to obtain, and let's scroll over here, $400, because if we sell it back for $5, the difference between $4.60 and $5 is 40 cents. So 40 times, and we go over here, we know this is a monthly option, which is 100 shares. So 40 times the 10 contracts, 40 cent times the 10 contracts times 100 shares, that's going to give me a $400 profit. Okay, so I'm going to show you what I did instead of placing the straddle, and this has a lot to do with call options and put options. And this is what you guys are going to be learning: how to buy a call option and how to buy a put option. And we're getting a little ahead of the game, but I just want to explain to you guys how this works and how beautiful these trades can really turn out. So I'm going to put this video on pause once again, and we're going to go back to the Thinkorswim platform.